Welcome everybody. Thanks for joining this evening. Welcome to this three-part masterclass called Venture Investing for Angels. Today is part one. We'll be talking about first principles. Let me go ahead by introducing myself and getting this session rolling. By the way, we will be recording all of this. I will be sharing the recording and also the session slides after this. So as long as you've registered, you will receive this after this. So don't worry about taking screenshots and whatnot. You'll get it in your inbox, okay? Now, before I get going, let me drop a few links into the chat. If it's the first time that we're meeting, we haven't known each other, and you want to connect on LinkedIn, please feel free to do so. I've attached a link to a LinkedIn post where I announced this masterclass event last week. If you could take your time to just go there and to drop me a like and a comment, that would be super helpful. And finally, if you know somebody who wants an invite into this session for parts 2 and 3, there's a link as well. Okay, so with that, let's get started. Now, as I mentioned, this will be a three-part masterclass. Today is the session one, will be Angel Investing First Principles. Next week on July 30th, we'll be covering Venture Math. And then the third session, August 6th, we will be covering due diligence and decision making. Today's agenda, we will start with some introductions. I'm going to be talking about investment thesis, how you should think about that. Secondly, helping you think through your options as an investor, and then leaving you with some guidelines, and we'll close off the session in about maybe 45 minutes. And I will try to leave some time for Q&A in case any of you want to have a chat. Okay, and I'm very happy to stay longer if needed. Very quickly introducing myself. In case you don't know me, my name is Jed. I'm based in Singapore. Formerly a tech operator. My last venture, I was building an API marketplace business. Think of this like an app store for API services. We got funding from Andreessen Horowitz at seed stage, and this became the world's largest API marketplace. Now, I started angel investing around 2016, and I'm completely self-taught. I've never worked in VC. So I've invested my own capital and I've learned these skills by myself. And at this point in my career, I've got an exit and I backed 2 companies at seed stage that have turned unicorn. In 2020, I started building my own syndicate. So this is a network of other investors that want to follow my deal flow, and I share that with them and my diligence with no strings attached. And we've grown that network today to 1,300 investors around the world. And so we're really proud of that scale. My latest venture is AngelSchool.vc. You can think of us as an angel accelerator, the same way there are accelerators for founders and startups. And what we want to do and contribute to venture ecosystems is to create the capital side of the equation, the same way that there are accelerators and incubators that help founders and startups. We see ourselves helping investors getting into this game. And we want to help you all the way from getting started, writing your first check, all the way to leading syndicates as super angels like myself. Now, with Angel School, there is a very strong mission and purpose behind it, because I think the perception of angel investing looks like this. This is what people sort of think when they think about what I do, right? You think about somebody who just falls from the sky with bags of money, whereas the reality of doing venture investing as an angel, well, looks a bit more like this. So if you think about after this webinar, what I'm going to be doing in 1 or 2 hours is diligence late at night. And so it's really not that easy, right? And part of the reason it's not that easy, it's because there isn't a lot of like good education, right? Or the knowledge that's being shared isn't very well structured, which is why our mission is basically to be able to package up and to share this knowledge with the community and to make venture more accessible for all of you. So today we'll give you a glimpse into some of the accumulated knowledge that we've built up. And hopefully this is something that's helpful for all of you. Now, before we get in, I've realized that in venture, there's a lot of fancy terms and terminology. So I don't know what the mix is of everyone here. Some of you might be totally new to this. So I'm going to start with some terminology, right? Just make sure that we all understand the things that I'm going to mention. So for today, session terminology looks like this. The first term is limited partner or LP. So if you ever hear the term LP, think of this as a catch-all term for investors. Generally speaking, LPs are the silent or passive investors in a VC fund. We refer to angel investors, to members of a syndicate as LPs. Also, it's not strictly the case. The lines get a bit fuzzy, but generally speaking, whenever you hear the term LPs, just think investor. The next term is a GP or general partner or a fund manager. They all mean the same thing. A GP is basically the person that's running a VC fund, and they take care of fundraising, making investment decisions, and updating their investors or LPs. Sometimes for what I do, running a syndicate, people might refer to me as a GP, and this is simply to equivocate the roles of a fund manager and a syndicate lead. It's not strictly the case, but you can think of GP basically as somebody that's managing a pool of capital. Next, if you hear the term carried interest, or people will abbreviate it as carry, it means the same thing. Okay. So think of carried interest as an incentive mechanism. This would be the percentage of profit from investments retained to pay the GPs or fund manager. So think of it as a profit sharing mechanism. And the industry standard is 20%. So very commonly, if somebody invests into a VC fund, if the fund produces a return above 1x, which is the original capital that investors have invested, anything above that is profit, and the fund would take 20% of carried interest on that upside and return everything else to investors. So that's the concept of carried interest. Next is a VC fund. This one most of you should know. Think of this as a mutual fund. So investors or LPs would commit to invest some amount of money to this fund, and this is controlled by the fund manager or the GP. And the fund manager is going to be compensated on annual management fees, which is usually 2% a year of the total fund size, and there is carried interest of 20%. Okay, so if you hear in venture capital something called 2 and 20, this basically refers to the business model of venture capital. So every year, a venture capital fund would take 2% of the invested capital for fees, and that pays the fund, the GPs, the team, salaries, rent, all of these things. And anything above 1x return, there's 20% carried interest. And then finally, there is a syndicate, which is what I do. Think of this as an informal group of investors that pool capital into a single investment vehicle. And the purpose here is to invite my LPs. They get all of my deal flow and they invest into startups on a deal-by-deal basis. A few more terms. Is liquidity. So think of liquidity as the ability of an investment to produce you a liquid return. So liquidity, having like the ability to buy and sell an asset, just like public stocks, basically lets you transact at lower cost. Another term that sounds very similar but is very different actually is called a liquidity event or an exit. This is basically when a company gets acquired, there's an IPO, they go public, or a secondary sale. cash is returned to investors, and this is a liquidity event or an exit. And then finally, we have liquidation preferences. So liquidation preferences simply refers to a clause which it's an investor right. And this gives investors the right to recover their investment whenever there's a liquidation. It basically says that whenever you as an investor invest in venture, you're entitled to 100% of your money back before any capital is given out to the fund manager. Okay, so that's our search session terminology. Let's move on. Before I move on, I do want to dwell on this point of the concept of a syndicate because it's actually not all of that common. Some of you who know me or are more experienced in venture, you'll understand this concept. But if you're not, think of a syndicate as this is explaining the concept of a syndicate. What I do as the syndicate lead in the middle is to serve two sets of stakeholders. On the left, we have investors or LPs. These can range from individual angel investors all the way to family offices or even some smaller VC funds. And what I do for them is to provide them curated deal flow because I do global scale deal sourcing. I do full diligence. I package up data rooms and I let my investors build their own portfolio. They have zero commitment to invest. They can pick and choose any company that they want to invest in. It can be zero, it could be one, it could be all of them or anything in between. And on the right, I serve startups. What we do is to help startups access capital, and that's because we have over 1,300 investor relationships. It lets us very easily write 100,000 up to $1 million check. And for the startups, they get a clean cap table, right? It's one single investor on the cap table, and it's a 6 or 7 figure check. And if they're well set up, we can also provide them access to a global expert network. Okay, so this is just the concept of a syndicate that I wanted to explain. Now, the first thing that I want to start out with is talking about investment thesis. Some of you might have seen some of my talks before, and I always start out with this content. So apologies if some of this is repetitive, but on a first principles levels, when I'm talking to somebody for the first time, these are the things that I will talk through. Okay, so investment thesis. What is this? You can think of an investment thesis as the boundaries or the focus areas where you decide to invest. Anything within this sphere, anything outside of it should be out of bounds, right? You shouldn't even be taking a look at it. The reason that you need to have an investment thesis is that the world is a big and noisy place, and it's so fast moving. And for all of us, there's only so much that we can know, right? If you're being honest with ourselves. So you really want to have some focus areas to give yourself an advantage in terms of what you invest in to give yourself the best possible chance of success. There are different forms of investment thesis, different levels of complexity. So I'm just going to start with the very, very basic. The most basic thesis and framework that I can come up with looks like this. Think about your sector and domain. Which verticals or industries do you invest in? Second, geography. Where do you deploy capital? Which continents or countries or even cities do you look at? And finally, what stage of companies do you invest in? Okay, so think about your investment thesis when you're starting out as a Venn diagram of these three things and mapping out where the centerpiece is. That's where you need to be investing. Okay, so you need to draw boundaries because you need the focus, and this is what's going to give you the best possible chance to be successful. Now, when you think about what drives these decisions for investors, there's a lot of human psychology at play here, right? A lot of things that make intuitive sense. And I know this because, simply put, I talk to a lot of investors and I know every single one of my investors, right? And I meet people all the time. The things that I've noticed look like this. When it comes to sector or domain, what drives investors' decisions is number one, familiarity. What do you know? It's very intuitive that whatever you're comfortable with, maybe through your work experience or your expertise or in education, that's going to be what you're going to gravitate to. The second is affinity. It could be something that you care about. For example, you have been through a really painful litigation, or you work with a lawyer and it costs you way too much money, and suddenly you think the world needs a lot more legal tech because it would make the world a better place. And that's absolutely fair. And finally, it could be a matter of interest. If you invested in cryptocurrency like Bitcoin really on and made a bunch of money, you're probably going to be a lot more interested in Web3 startups just because you've had your own success in that sector. Second, for geography, what we know is that early stage capital is very, very highly localized. In fact, the earlier the stage that you invest in, the more it's going to be local, right? For you as an individual angel, if you're probably going to be a pre-seed stage investor investing individually. And so you are going to be looking at your country, your state, or even your city level in your own backyard. I look at companies all around the world, and we look at a lot of companies in the US, and we know that we might be looking at a company in the West Coast, and the investors on the East Coast don't even know about it. It's just not on their radar, and vice versa. This is just a function of how early stage venture works. Now, the only other reason that you would consider investing in another geography where you don't live in is because there's some kind of connection. So, for example, if you're part of the Indian diaspora, maybe you live in the US, you would have an interest in investing in India as well because, it's where you grew up and you have a vested interest in seeing the country develop. And finally, the stage that you invest in, the kind of companies, the stage of companies you invest in is largely a function of capital. If you are an angel investor writing a 4 or 5 figure check, maybe even up to mid 5 figures, you're going to be investing at pre-seed up to seed stage. In order to play at seed to series A, realistically, you need to be able to write 30,000, maybe up to a 6-figure check, maybe $500,000. And if you want to get into series A's and B's, you need to be writing $250,000 up to millions of dollars of checks. So for most individual investors, or actually all investors, the check size that you write is going to dictate the stage that you play in. And I think this is like one argument of why investors should pay attention to other vehicles beyond just investing directly your own capital. Because investing through a syndicate or even a VC fund gives you a way to extend your stage access. Because you might say, hey, investing in pre-seed companies is actually really, really risky and it's above my risk tolerance. And I would rather invest at seed stage, series A or series B, but I can't do it because I write a small check. And so these other investment vehicles give you a way to choose your options. And very quickly, to add some color to this, let me talk about our investment thesis at Angel School. For the sector, we are mainly B2B technology and software investors. Why? The reason is that we believe that good technical founders should be able to build, ship product, and get traction with software, generally speaking. Not always the case, but generally so. And it's a lot harder with sectors like hardware. And this becomes a way for us to de-risk because we don't invest in pre-product, pre-revenue companies. Even on the companies that I've invested in at pre-seed, they've all had a product in market and they've all had revenue. And longer term, software companies, it's much more scalable because everything is digital, it's online. And so as an investor, it's less long run dilution, right? So it's cheaper to scale. And so the return should be better. Next, for geography, we're a little bit different, right? Because we built such a big network and it's global. We invest across US, Europe, and Asia. We split our 1,300 investors into 3 geographic clusters. We have our US cluster, which everybody's looking at the deal flow there because that's exactly where we started 3 or 4 years ago. And we launch our Europe and Asia teams about a year ago. And so it's earlier stages, and we have about 300 or so investors following the deal flow in those clusters. And then finally, for the stage, we tend to play at seed stage up to Series A. We might do a pre-seed deal and write a relatively small check, which would be $100,000 or $200,000. But seed to Series A, we're probably writing $500,000 up to $1 million checks. And the whole strategy and goal for us is to keep growing the network so that we can keep scaling capital. And so maybe in a year, we'll be writing multi-million-dollar checks. We'll be playing up to Series B or C. I kind of want to open up the stages and to approach this as a strategic decision, not as something that I play at because I'm restricted by capital. So that's how I think about it. Okay, next. Let's talk about evaluating your options. If you are an angel investor getting into venture investing, what are your options? There's basically three channels that you can go into. You can stay as an angel investor doing direct deals into startups. You can be part of a syndicate like mine or many others, or you can invest through a VC fund. These options are not mutually exclusive. You have to decide what works best for you. Even though I would say that for angel investors, we tend to see them do direct deals and syndicates together, and VC funds as a separate bucket, right? There tends to be less overlap between the first two and the third one. So we'll get into the reasons why later. What I would like to start out with when you're thinking about the option is making sure you understand what the return patterns look like. And then we'll talk about the qualitative differences among these three options. And I'm going to give you my recommendation or my framework for how to think about this. So let's start out with the first one, which is being an angel investor. So if you are an angel investor, you are going to invest directly into deals. And let's say you invest into some number of companies, N. Okay, so that's the number. Let's say that you as an investor invest in all of these companies. Each bar here represents one company. And the bars are the same height because you invested the same amount into each company, let's say $1,000 or whatever it is. Now, if you're going to be doing venture, what you should be looking for is companies that has a theoretically multiples upside, super high upside. But on the other hand, each investment that you do has a limited downside. The worst you can do is basically lose all of your money. Right? And because the risk reward is so stark, you basically need to be playing for companies that have a really outsized return, because there's a very good chance that a lot of the companies you invest in are going to go to zero. And so let's say your portfolio looks like this. The green bars are going to represent companies that return a positive profit, and the ones in red actually lose money. So the way to think about your returns as an angel investor is that your portfolio return is just going to be the summation of all the individual portfolio companies. So here, this 1x return line on your portfolio represents the sum of all the capital that you invest in. And we're hoping that in this case, the green bars are more than offset the red bars, which is the losers. And here, your portfolio return is just going to be the green bar here, right? Everything above 1x. So really straightforward portfolio management. Next, let's look at your return patterns if you invest into a syndicate. So if you're a member of a syndicate, imagine that you get presented this series of deals, these 6 companies from A, B, C, D, E, F. Now, the power and the value of being part of a syndicate is that you as an investor gets to decide which companies to invest in and how much, okay? So the decision-making power is in your hands. I would say on the average deal that you invest in on a syndicate, expect around 5% of your capital, maybe up to 7%, going towards administrative costs. So this will cover a little bit of management fee and also an SPV. So this is the vehicle, the legal vehicle that manages the money over the life of the fund, of the investment. So 5 to 7%, we're just going to use 5% for simplicity, which means that every investment that you make, 95% of the capital actually gets deployed into the portfolio companies. In this case, you as an investor, you choose to invest in companies B, D, and E, so the blue ones here. And so your returns is going to be restricted only to these companies, obviously, right? And here we are calculating returns as anything above the 1x. So even though 95 cents on the dollar gets deployed into the actual company, we're only calculating profits above your original 1x. So in this case, company B does okay, has a return. Company D loses money, and company E does really, really well. Now, by the way, everyone, I'm starting to see questions trickle in. So feel free to leave it in chat, make it a public message, and I will turn to questions after this and we can have a discussion. So coming back to this. In this case, the way we calculate your returns is that as an investor in a syndicate, you're entitled to 1x liquidation preference, which means that you get your original capital back, which is the 1x. Above that, the syndicate will take 20% carried interest. So above 1x, you would get 80 cents of every dollar that is returned. So on company B and company E, these profits, you will get your original 1x of capital back plus 80 cents of the profit, or 80% of the profit for these two companies. And on company D, which loses money, unfortunately, you get whatever residual value is left over, and the syndicate lead does not take any profit share from. Okay, so this is the return pattern for a syndicate investor. And finally, for a fund, this is your returns profile as an investor into a venture capital fund. Now, with a venture capital fund, early on, I spoke about the 2 and 20 business model. Again, that means 2% of your capital going towards management fee every single year and 20% carried interest, which is the profit. The average fund life is 10 years. So 2% a year times 10 years basically is 20%, which means that if you invested as an investor into a VC fund, you are going to be paying 20% management fee over the 10-year fund life, and 80% of your capital actually gets deployed into the portfolio companies. Now, what happens here is that the fund manager is going to deploy this 80% of capital into a number of portfolio companies. You don't get visibility into this as an investor. Okay, the fund manager or GP is deciding all of this. Now, let's say that the portfolio returns this pattern. The companies in green is profitable and the ones in red lose money. In this case, the total portfolio return looks like this. Again, we are calculating portfolio return as everything above the 1x return line, even though only 80% of the capital invested actually gets deployed. And in this case, great. The winners on the portfolio return above 1x, and it outweighs all the losers. So as an investor in the fund, your returns waterfall looks like this. You are entitled to your original capital back. 100%, this is your 1x liquidation preference. Sometimes the fund will have a return hurdle, which means that the fund needs to return you some fixed amount of return a year. Usually it's 7-8% before the carried interest apply. And so in this case, above this, the portfolio would return you 80 cents on the dollar for any profit above that. and the fund manager will take 20% carried interest. So this summarizes the return patterns for a fund investor. Now, if you think about all of your options, right, these three buckets, you can be an independent angel on the left, be part of a syndicate in blue, or invest in a VC fund in green. Again, I will stress that these are not mutually exclusive. You can pick and choose what works for you. There's a lot of different ways to think about this, from filtering and curation, deal access, how much diligence you receive, the decision control, etc., etc. There's a lot of detail here in this slide. I'm going to fast forward a little bit and to just give you the takeaway because we're a little bit short on time for the content. If you look at all of this, the way I think about it as an angel, if I was looking this as an angel investor, it basically comes down to this. Firstly, VC funds, this is a big ticket blind pool vehicle. You are completely passive. So you need to be able to write at the very, very low end, a $250,000 check up to millions or tens of millions. And so because of the cost of entry, this basically disqualifies 99% of all angel investors. It's just not accessible. Even if you could afford it, is this what you want to do? Do you want to be completely passive? Most people, it just rules it out, which basically means that your options are to be an independent angel or to invest through a syndicate. I don't think you have to pick and choose. You should keep your options in hand and to pick the best of both worlds. But what is the argument for you to be part of a syndicate? It comes down to this for me. I think that if you pay attention to the right syndicates, you get curation, better deal access, and filtering benefits. You should be getting a diligence benefit, although I will say that it does vary from group to group. The simplest thing that you can do here is that if you're picking and evaluating a syndicate, ask them for the due diligence on a recent deal and to just see, does this meet your bar for what good due diligence looks like? And if it does, it's somebody that you can follow. If they don't have any diligence, then probably don't spend your time on that. Now, in both cases, whether you invest as an angel or be part of a syndicate, you have 100% decision control over your portfolio. So there's no trade-off here. I think there's a time saving because somebody like me, I find it fun to do diligence, even if it takes me late in the night. And so somebody is doing the heavy lift for you. There's also a diversification benefit. You get to spread your capital into a broader range of stages. You get better quality deal flow for whatever you want to invest in. The trade-off that you have to make is there are some fees and you do pay carried interest. So you have to decide for yourself whether it is worth it. And it's up to all of you, right? I'll say for myself, I follow other syndicates. If I see a deal that I'm really excited by, I have no issue investing and to pay carried interest. So that's my decision, but you have to decide for yourself. Okay, moving on. What I do want to move on to, and this is really important, is talking about some guidelines for you as angel investors starting out. Firstly, if you are new to venture and you're starting out, the first message I'm going to tell you is make sure that you have a full acceptance of the risk. Assume that whatever you invest in venture is going to go to zero. You need to be prepared to walk away. You cannot expect liquidity to get cash back until an exit event. Even if a company that you invested in, they get a seed stage funding, a Series A or Series B, and there's a valuation on these shares, you cannot assume that there is going to be a buyer. There could be, but you cannot assume so. Okay, so you need to go into this with eyes wide open and to be prepared that you need to be in it for the long game. Otherwise, don't get started. That's my advice. The second thing is take your time. When you're starting out, it might not feel like it because you don't really have your deal flow channels. You don't know how to evaluate companies, but really deal flow is limitless. Okay, the constraint for all of you as investors is capital. So get plenty of exposure, see lots of pitch decks, but be stingy with writing checks. Definitely one of the early mistakes I made when I started angel investing was that I was super excited and everything looked like a winner for me, right? And you think you're going to be amazing at this, but the reality is that probably not so much. So you definitely want to keep your early euphoria in check. And this is why I do the education for the community, because I want to help everyone understand what good looks like so that you can calibrate your bar before you even have to write a check. Thirdly, diversification matters. A lot of the companies that you invest in are going to go to zero. You might have one winning company out of every 10 or 20 startups that you invest in. So you need to be committed to building a portfolio. Now, that said, take your time with it. Again, going back to my point that capital is finite, don't be in a rush to write checks. You're in this for the long game. You can diversify by building a portfolio over a period of many years. And one of the things that we hear all the time in venture is that it's a game of power law, right? This is something that VCs say all the time. It is kind of true, but I sort of disagree with it. So I want to explain why I disagree with power law. Okay, so let me take a sidestep here and to explain this. If you ever hear this thing in venture capital where people say VC is a game of power law, this basically is a reframing of the 80-20 rule. So think about a bunch of companies that you invest in and how they perform in terms of returns. On the left, you have very few companies that return a really high multiple, and then you have a long tail that just don't return very much or outright go to zero. Okay, so visually, this is the concept of power law. I think that power law is aligned with the venture capital industry, but it's less relevant for angel investors. The implications are actually really different. So let me explain what I mean by this. Power law, again, is broadly true, but it's something that is aligned with venture capital because there's actually a lot of pressure points associated with running a VC fund. The first one is that if you think about the fund business model, that 2 and 20 model of management fees and carry, the incentives for a VC fund is to keep growing the fund size and to grow their AUM because it means more capital to deploy and more fees for them. Second, VC funds need to deploy funds very, very quickly. There's a lot of pressure. Once you say go, you got to start deploying. To give you a sense of the timing of this is that for a 10-year fund life, in years 1 to 3, the fund needs to invest in 20 to 30 portfolio companies. They spend year 5 to 7 watching and doubling down on the companies that are winners. And in year 10 onwards, they need to start returning liquidity or capital to investors. If you are maintaining a 100 to 1 selection rate, that basically means evaluating 2,000 to 3,000 startups in every year for the first 3 years. And that basically breaks down to evaluating 50 to 90 startups every single month. So if you think about the amount of work that needs to get done to do this, it's a lot. And if you want to ramp up your AUM, invest in more companies, the pressure even grows even more. So bear in mind also that a VC fund they're going to be severely constrained by the deal pipeline, the team bandwidth, and a fixed pool of expertise and knowledge, which is why I say with power law, there is a tension between diversification and skill, right? The more you want to deploy, the more you need the quality of the deals to slide. I'm going to skip this slide just because in the interest of time and to move on. So my next set of tips when we talk about portfolio construction and guidelines is that let's give you a reality check. Generally speaking, when you are starting out, the truism, you can expect that you're going to be low on skills and experience. Okay? Your pool of capital for venture is also fixed. It's not going to increase significantly in the near term. And your access to deal flow is actually pretty constrained, right? Because you're writing relatively small checks. Next, you want to make small bets early because the psychology of investing changes once you stake capital. It is important to experience this. However, because your decision making is also porous when you're starting out, it makes sense to make undersized bets early to familiarize yourself to learn. And so being part of a syndicate is a way to improve your deal access, to learn for due diligence, to diversify with a smaller check. And next, you need to be playing for life-changing outcomes. Okay, the whole point of investing in venture is to get outsized returns, and we're talking about 10x, 20x, 50 or 100x your money. And so my argument here is that if you back the startup that returns 100x, and let's say you wrote a really small check, let's say $1,000, $1,000 with 100x return gives you $100,000. It's a little bit so what, right? It's a nice amount of money, but it's not life changing. But on the other hand, if you invested $10,000 and you 100x into $1,000,000, now it's a much, much better outcome for you. On this topic of getting life changing returns, I would say that you definitely want to get into this mindset. Some of the times I hear in venture capital when VCs will say, hey, angel investors, they don't need to make the same return as us as VCs. I kind of disagree, right? Isn't it your right as angel investors that we invest even earlier than the VCs, and we take on greater risk? Aren't we entitled to better returns? Why should we compromise? Okay, so get into this mindset. Really, just don't take on all of this risk and compromise your returns. To put all of this in perspective, I'm going to give you some data to give you some perspective on what VC capital returns look like. Okay, what you're looking at here is VC capital returns from 2009 to 2018. If you look at this time period in the US, it's actually the great times in VC. This is when things were going well. And the data says that the average VC fund, they will deploy 50% of capital in this first bar here and into companies that return less than 1x. So it actually loses money. And 30% of the capital returns 1 to 3x, 9% returns 3 to 5x, and so on and so forth. Now, some of you will know that one of my better investments is a company that I invested in called Turing.com. I invested in their seed stage. Our expectation is that Turing is going to IPO next year, potentially, if the markets turn. So I invested at seed stage, wrote a personal check, and at the Series B, we had our syndicate. So I actually doubled down with another $500,000 check. And so when this company exits, if we get a full liquidity like we expect, this will be 100 or 200x multiplier. And that's fantastic, right? It's a really great outcome and it's a very big validation. I'm also realistic that if you chart that outcome on against these statistics, the probability of getting this unicorn 100x multiple return is 1 in 10,000 or more, right? It's so far off this chart. Actually, we can't really objectively say if I was lucky or there was some skill involved. So the purpose of showing you this data is to just give you some perspective of the probabilities of getting these kinds of returns and why you need to scrutinize your investments really hard, number one. And secondly, to make sure you diversify by investing into enough companies so you give yourself a chance to hit the outlier returns. And finally, kind of wrapping up here on portfolio construction. My best advice, if you are starting out, and I would advise myself the same thing if I could rewind time, is that focus on investing in your skill as an investor. So learning diligence is something that takes many reps, a lot of time to develop. Start working on this early because this is going to carry you through in the long term. Next, be part of syndicates. I know I've said this multiple times, and I have my own syndicate. I'm not trying to drive you to my syndicate. There are others out there doing really good work. Let somebody else do the heavy lift for you. Okay. Let somebody else go out, find the deals, do the diligence on your behalf. You as an investor don't have to invest in any of these companies, and you get to learn from their diligence. So it's a way of shortcutting your learning process and de-risking. But be aware that not every syndicate has high standards, so you want to pick and choose carefully. Final thing that I will say is think about your outcome levers. Okay, you have multiple ways to improve your odds of venture success. It isn't simply about how many deals you're investing in, how much capital that you're deploying. Okay, there are actually lots of different ways where you can affect the outcome. I'll give you a simple way, which is how you can scale on capital and to take carried interest. Going back to this data, which I showed you earlier, we looked at these VC capital return patterns. Let's say we performed like this and we were completely average to the VC venture capital industry. This data actually says that getting this 100x return multiplier is really, really off this chart. However, if you think about getting a 10x return, the probability of this is around 8%. So 8% is not huge. It's not a certainty, but it's not astronomically small either. We're talking about a 1 in 12 probability. Now, if you wrote a check as an angel investor, and you get a 10x return, it's okay. It's nice. But think about the ability of a syndicate to scale capital. So as a syndicate, if I could write a $500,000 check, we 10x that into $5 million, and we take 20% carry, that's $1 million financial payout from a 10x return, right? So we get the same financial dollar payout from a 10x return as the unicorn probability with 100x. So this is an example of what I mean by thinking about other creative ways, such as the investment vehicle, to move the needle in your favor. Okay, so I'll just start to wrap up today's session and to leave a few minutes for questions. I want to talk about our contribution to venture with Angel School. We're really proud of our program approach, right? The way we want to help the community is in this 1, 2, 3 format. We have a couple of programs that we teach. The first one is Venture Fundamentals. This is essentially about giving you all essential venture skills in just 10 hours. This is the 10 hours I wish I had when I started 8 years ago before I started writing checks. The other program we have is our Syndicate Blueprint. In this program, we help angel investors who want to scale up, run their own angel networks, and to do syndicated deals like I do. We teach that. Anyone who goes through our program gets a seat on our investment committee. So the reason that we created this investment committee structure is that we give you the ability to get hands-on deal experience and to build your track record. As part of being on the IC, you get enrolled in our carry sharing program. So every deal that Angel School does, you are entitled to a slice of the upside. And by the way, being part of the investment committee is about giving you exposure and experience. There is zero expectation to invest. So we want to give you the education and also to give you a way to learn. And you can learn without risking your own capital until you're ready. Okay, so that is our philosophy. And finally, when you're ready, you can take off, which means investing on your own. And for those of you that want to run your own angel networks, you can launch your own syndicate. And we're really proud of the impact that we're making at this point as a bootstrap organization. We've impacted 200 to 300 investors from 30 different countries. These are some of the people in our community. We're really lucky and proud to work with them. So some really smart and really smart and professional people and known experts in their fields. And if you want to be part of this, I'm really looking forward to having you part of this. At this point, I think I'll open it up to all of you in case you have any questions. A quick plug. We run our venture fundamental program as an online program. Our next intake actually is in September, and we've actually decided to open up a special program, a live in-person session in August. So August 24th to 25th, I'll be running a live 1.5 day boot camp at INSEAD, the graduate school's campus here in Singapore. And so I'll be teaching this live. The program fee is basically the same as the online version, except you get the full live experience. So with that, I'll open it up to questions, and let's have a discussion, and we can keep it interactive. So first thing, I'll address Gabrielle's question. Gabrielle, yes, we will be sharing the recording and also the slides. I'll send it out into your inbox, so just pay attention to that. And then this recording will be posted on YouTube, so you can check it out and also share with people. Anybody else, if you have a question, please feel free to speak up and ask.
Hey, Jed, this is Nat. Thank you for all this useful information. Two questions. One is a pretty simple one. I may have missed it in the beginning. So who in the syndicates take the carry? That's the first question.
Yeah. Hey, Nat, firstly, long time. Nice to see you. I don't think we talked since a reunion last year. So in a syndicate model, the syndicate lead, right? In this case, if it's our syndicate, we will take the 20% carry. And we actually take some of those carry and share it with the investment committee members. So that's kind of the carry sharing program that I spoke about. Does that make sense?
Yeah. So basically, the lead in the syndicate is kind of like a group of people, like let's say, I don't know, 3 to 5 or X people, that will take that carry.
Right. It could be one person, or it could be like a small group that run it, and it's up to them to self-organize.
Got it. Second question is, so you mentioned, diversify, make sure, you're kind of, you have to invest in multiple companies in order to basically hit like a winner, basically. So with that, then how much money would you need to basically start off with, right? If you intend to invest in 10 companies as an angel.
Yeah. This is a really hard question to answer, right? Because it's more like philosophical than anything. I'll give you my answer. I don't think it's really about how much pool of money. Obviously, you need to ring fence that to like manage your own risk. I think about the outcomes in terms of probabilistic returns, like how many of the companies you invest in actually produce like a positive multiple return versus the ones that lose money and are you net positive, right? Which is why I kind of stress the point about um, how do you find the best possible companies? How do you make the best possible decisions to move the odds in your favor, right? And so a lot of how we operate with Angel School, like the thinking and the strategy around it is to move the odds in our favor, right? By scaling our sourcing around the world, because basically the more that we look at, the chances are that you're just going to get better quality deal flow. And through our investment committee, we believe in that structure to actually scale our ability to do diligence and to make great decisions, right? And so we're kind of playing this game of probabilities. So it's a bit philosophical, but I hope that's a helpful perspective, Matt.
Thanks. I just realized I still have my virtual background on. But anyway, thank you.
Cool. Hey, AC, welcome from the search fund. Well, I think I'm talking about the same AC. Are you able to speak up and just ask the question? If not, I'll read it out. Okay, AC, I assume not. So the question from AC is, does syndicate also follow the 2 and 20 model? Broad answer, no. Generally speaking, syndicates will charge carried interest. On the high end, it's 20%. It shouldn't go more than that. And it does vary, right? Some will charge lower carried interest at the start to kind of build the base. So there's some variance. I would say with a syndicate, you might see 10 to 20% carry interest, but generally speaking, it kind of all goes all the way up to 20 in the limit. And then the 2% doesn't apply to syndicates. So this is one of the difficult parts, right? Syndicates won't charge 2% management fee every single year. Usually you can expect that 5-7% upfront of capital going towards fees. This covers the management fee and also the legal structure. So that's an all-in cost. And so I generally would not expect more than that. So whatever you invest in on any deal, make sure to clarify with the syndicate. If you're hearing a number 5-7% of the fees, which includes the SPV, that's the right ballpark. The other thing you need to care about is the carried interest. As long as it's not more than 20%, that's also okay in my view. And a question from Emil. He asks, I talked about ventures that don't make money, assume that they don't have an exit. How often does this happen? Because you're a startup founder with 2 exits, then Emil, awesome. Congratulations on your success. I would say that it's actually very common for ventures that don't make money and don't have an exit, right? For me, when I look at a company that even if they're break even, they're profitable, they're self-sustaining, they don't get to a scale that makes them attractive acquisition targets. It's the same for me as a company that goes bankrupt, right? Because, ultimately as an investor, I don't get my money back, which is why when we evaluate companies, we're very rigorous on the market size. Like, are they operating in a market where this can become a 10, 20, 30, 50, or even $100 million revenue business? Because that's the scale where they could potentially IPO, or they're attractive as a private equity or growth equity investor, like acquisition target. So yeah, that's my take. So evaluating market size, and then also making sure where the founder's head is at, right? That they want to build a big company. Those are the big decision variables for me. But it happens, quite a bit. I would say like pure exits are more rare than actual exits. And so in your case, if you've gotten 2 exits, I would say kudos for you. You're clearly above average. And I'm working backwards. Dominic, your question is fund business models, incentive versus AUM scale. What is the scale like? So I think you're asking like how big can the AUM of a fund scale? I would say that on the very, very low end, you have micro VC funds for a first-time fund manager. That might be $5 to $10 million. And some are even micro funds. People will go out to market with like $2-3 million, which honestly, for me, I think is a big, big mistake, right? It's just not worth your effort and all the risk. And on the higher end, we've seen VC funds that go into billion-dollar scale. And so Andreessen Horowitz, their new funds can be like billions of dollars, literally. So there's a very wide gamut. What we tend to see in terms of returns is that there is declining marginal returns, right? There is a positive effect with AUM scale and the returns, but beyond some certain point, there is a declining marginal returns. That's the pattern that we see.
Thank you.
Thanks, Dominic. Great question. And then question from JV. He asked this as a private chat. If you don't capital yourself but would like to start investing, how do you go about building a network of potential LPs? Well, I guess JV, I think to run a syndicate and angel network, you really need to start with the basics of your own fundamental investing. Okay, so if you yourself have no experienced investors, it's very hard for you to pick winning companies because you don't have the skill yet. And it's also hard for you to convince investors to follow your deal flow because you haven't investors yet. You haven't invested at all yet. You have no track record. And the third issue with that is that actually it creates an incentive misalignment problem that if you could build an investor network to invest in companies, and but you yourself have no skin in the game. You actually have upside, but no risk, right? So there's a problem there philosophically, in my view. So as much as I would like to give you a workaround on this, I would say get yourself in the right position, learn the investing skill yourself, and do this in the right order. If you're interested in the programs and what we teach, we can help you with skills acquisition. We can help you build up your skill without the need to invest capital until maybe sometime that you're ready. And once you have some experience, you can think about building your network later on. So that's my advice. Okay, we're sort of at time, a little bit over. How can you join Angel School AC? Depending on deal flow or programs, stay tuned for the follow-up email, which we will send out. It will have the slides, the recording, and also some information about how to find us. And feel free to reach out to me on LinkedIn. Like, my name is pretty distinctive, and I'm very happy to chat anytime. So with that, we'll wrap up today's session. I'll see you in exactly 1 week, part 2. Thank you, everybody. Have a good evening. Have a good afternoon, wherever you are in the world. Thanks for joining.